We welcome now Jeremy Nelson, the president of Element Wealth. Hey, Jeremy, been a while.
It has been a while. It's good to be with you today.
Yeah, man. So we like what we see today. A lot of green on the screen. The Dow up 350, 360 points. The NASDAQ 200 something, I think. Treasury yields are a mystery, honestly. Gold is a mystery. The funny money is a mystery. It feels like investors are... We went through a period where it was Fed watching. And I'm not saying we aren't still Fed watching, but now it's tariff watching, trade watching, right?
Yeah, I think we're kind of getting to that point now where what are the economic impacts of tariffs and and kind of our view on global trade. Obviously with the government shutdown, we're not getting all of the data, but we're kind of seeing, some of the major investment banks, putting out estimates of what they would expect right now. But yeah, I do think that we're kind of at a point now where we're going, okay, the Fed's made it clear that they're going to cut. They're not going to be as aggressive as the president would like, but they're going to cut a little bit here. So I feel like we know what's coming from the Fed. But what we don't know is the impact of tariffs, right? We don't know, how much corporations are eating versus how much is being passed through to the consumers.
There's all sorts of estimates about that, as you know, but we're not sure.
But we don't know. And then obviously, when things like impacts on employment, right? Well, we know that there's these massive revisions that have been going on for, not just this year. I think that's kind of a misnomer, that like the revisions to the jobs numbers that's not a new thing. That's been going on for quite a while. Now, obviously, the last one that got the
BLS.
The BLS person fired was the biggest, but it's been going on for quite a while because of the collection rate. But yeah, I think everyone's kind of holding on. The market is hanging in there. It's been a little bit more volatile. We're seeing a lot of days
where
the
VIX is up over 20, right?
We'll see days where the market opens up and finishes down, or opens down and finishes up. And so you're starting to get a little bit of a break in the trend, yin and yang. But today we're open up well. I think people are still optimistic.
Well, the president sort of softened his tone about his trade negotiations with China, and likes to boast about what a great relationship he has. He said, I don't know if you caught this, and I don't know if the market cares about this, but he said we should learn more about Xi Jinping's life story and background, that it's impressive. I don't know what he's talking about there. The president knows something.
I have.
And I don't know if investors are kicking in on that.
I have no clue, right? Because, we did see, 2 or 3 Fridays ago, we had that big 900-point sell-off in the Dow, right? Because we were going to put the tariffs in. And then he kind of backed off, and then he kind of got back on it. And, China is retaliating, right, with limitations on rare earth exports and things like that.
Yeah.
I don't see a solution here. I don't necessarily see a deal, right? We've kind of been waiting. We've been waiting on this for a long time, and I just feel like there's not a resolution at this point in time.
And with respect to trade policy, wouldn't you agree that our trade deal with China really just overshadows all the other ones?
It does, but it shouldn't.
I agree.
Right, because if we look at our exports to China are half of what we export to Canada.
That's true.
It's about what we export to Mexico. It's similar. So you actually see very similar import-export figures from China and Mexico.
They don't take as much of our stuff as China. As Canada and Mexico.
Yeah. Canada and the U.S. have actually a relatively balanced trade. So if we look at our largest export market on a single country, it's Canada.
Yeah, that's right.
Yeah, and so it's going to affect all of the cheap crap, right?
I'm thinking more of the reverse. I'm thinking more of the import side of things.
And that's ultimately where it hits the consumer, is that on a lot of the low value goods that we buy from China, they're more expensive.
Right.
But they're still the low value goods. It's not the expensive stuff. So
Yeah.
I don't see the China trade deal as like the biggest, most important deal that we have.
Okay. Well, it seems like the market's hanging on it, though. Is the reason I point that out, and there's probably another dimension to it in that we are heavily reliant on China for things like rare earth minerals that we can't produce here or don't have the means to do at this point.
We're seeing an impact with that, and we're seeing an impact with farming.
Yeah.
Right. So
not buying our soybeans.
Not buying our soybeans, right? So China's retaliation is, okay, well, we're going to go to Brazil and Argentina. And now, the president's come out and said, well, we're going to take some of this tariff revenue and subsidize the farmers. And the farmers are saying, well, no, we don't want subsidies. We just want to be able to sell our product.
Because that's not permanent. It's a one-time deal. And a lot of the farmers are expressing concern that China may never buy our soybeans again, which would be devastating.
Well, and I do think that as you get into negotiations with a country like China, they don't have, a republic like we do, a democracy like we do, or, they're not parliamentarian like the Brits or the Canadians or the Aussies, right? So they've got a 100-year plan. They're willing to wait some of this out. And I think that that's what we see in that there hasn't been, a real formal meeting with Xi Jinping and President Trump. I think that they're really kind of holding on, and they're, rattling the sabers a little bit.
Yeah.
And so I think that this is something that continues on. But I don't know that from a broad market perspective, yes, it's impacting farming in certain areas, and we're going to see low-value goods be a little bit more expensive. But that's not enough to just take down the American economy.
No, agree. All right, but this is it's a pretty significant week from an earnings perspective, and investors are bracing for that. Do you think maybe that today's bull market indicates optimism about the earnings reports?
Yeah, and I think that you're going to see, relatively decent earnings within the tech sector. I think you're going to probably see within some other sectors a little bit more weakness. But here's the thing about the tech earnings right now is a lot of this is somewhat incestuous.
Yeah.
Right? Like
it's hard to track, isn't it?
It is. Like, I mean, so for instance, we talk about, Oracle has signed this $300 billion contract with OpenAI. Well, the annual value of that contract is more than OpenAI's actual annual revenue right now. Right? So the big question becomes, okay, yeah, we're seeing these corporations doing these deals that's driving up the estimates and driving the revenue. Some of it's being subsidized, through venture capital that's invested in these AI companies, but they're losing money. And so what ultimately has to happen for it to be sustainable is you're going to have to start to see the actual spend on AI from the consumer and businesses justify the spend in the infrastructure.
Yeah. Because they're certainly planning on that. They're expecting that. They're positioning for it. And then AMD as well, cutting deals, right?
So I was literally about to point this out. I find one of the things I've talked about for a while is, NVIDIA really had a stranglehold with the chips for AI. And all of a sudden, but one of the things I talked about was that eventually competition catches up, right? The margins that they had in that business would erode at some point, because I remember 2 years ago, the CEO of Amazon, Andy Jaffrey, right?
Yep.
He was talking about how Amazon wanted to create their own chips. Now, obviously, they were way away on that, but Google wants to do the same thing. Yeah. They were concerned about the concentration of supply in chips being from one company, and I said, well, ultimately, what's going to happen is like the AMDs or maybe even the Intels of the world would start to catch up a little bit. That would create competition and compress margins. Well, now what do we see, right? A $50 billion deal between AMD and OpenAI.
OpenAI still is yet to produce a profit.
Not even close. Yeah,
right.
The estimates that I've seen is that they have about $12 billion a year of revenue. They're valued at over $500 billion. and that they're losing $5 billion a year.
Unbelievable. Kind of reminds me of Amazon in the e-commerce business until AWS. Well, AWS was carrying them. And now, of course, they turned the corner. The e-commerce business makes money.
Yeah.
We're going to take a break. We got Jeremy Nelson coming back in the Element Wealth studio. AMD, by the way, very impressive CEO, isn't she?
She is very impressive.
She's awesome.
Yeah.
We're coming right back. Stay with us. We're back with you in the Element Wealth studio, visiting with Jeremy Nelson, the president of Element Wealth. Okay, so it's a volatile market. The VIX, which is the measurement of volatility, for those maybe not familiar with that, it's north of 20. Anything over, 13, 14 is considered volatile, I think, generally speaking?
Yeah. I mean, I kind of look at that 13 to 17 range.
Okay.
It's generally, pretty normal.
Okay.
Right? When you start getting below 13, you're going, it's, volatility's a little soft. And, 17's not crazy. When you start getting 20 and up, that's where you go, okay, you start to pay attention.
And that's how we end up with days that you described in the last segment as well. We opened up 200 or 300, but we closed down 500. I mean, or vice versa, right?
And what that's showing is that there's less conviction, there's a little bit more of a mix of bulls and bears, and there's kind of like a struggle for control. I think ultimately right now the bulls are still winning. The longer term concern is just valuations.
Yeah.
Right? But valuations are not a good timing metric.
Yeah.
I mean, there's no way you can look at the market today and say it's cheap.
Yeah.
I mean, you're talking about 30 times earnings on the S&P 500. So, it's not cheap. But, it's also not 1999. Now, some people will come to me and say, well, it's not like 99 because back then none of the tech companies were making money. Well, that's not true because the four horsemen were actually making money.
They were
back
making
then,
money, yeah.
Right? The big guys were making money. Yes, there were the Pets.coms of the world. But there's, so there are similarities. I do think that fundamentally the Mag 7, or we look at the almost 40% or so of the S&P 500 is in the top 10 stocks. That concentration does worry me, but ultimately, these companies are fundamentally better than broadly what we saw in 1999.
What does concern me, however, is that there's a bit of enthusiasm over our GDP. Of course, GDP always a strong indicator and is considered a bullish factor for investors. But I'm not sure if you saw this, but I caught a report that I dug into in great detail that if you take out investment in data center infrastructure, instead of having a 3.5% GDP, it's like 0.1 or something. So the rest of the economy not really growing at that level.
What I would tell you right now is what's propping up the economy is kind of the field of dreams with AI.
Yeah, no doubt.
Now, and that's why I pointed out earlier, eventually the consumer is going to have to start spending money on this in order to make it profitable because, hypothetically, right, like what happens if OpenAI's revenue doesn't get to where it needs to be and they've got this $300 billion contract with Oracle that they can't afford? Well, obviously Oracle believes that they're going to get there in order to do the contract, to make the investment. But there's also a bit of an arms race here, right? Where, a couple years ago, Mark Zuckerberg, Meta CEO, came out and said, I would rather over-invest, right, than underinvest in this right now. You don't want to get behind, right? And there's been a lot of criticism about like Apple being behind.
Intel.
Yeah.
Well, Intel missed the boat years ago. Yeah. And we're one of the four horsemen in the 90s that built out the internet. They, Dell, Cisco, Microsoft. Yeah. So, and all those companies were making money back then, to your point.
Very profitable.
Yeah, extremely.
But what you saw, if you actually go back and you look at the revenues of those companies back then, they started scaling up rapidly, and then there was like an air gap, and they dropped.
Yeah.
Because there was an overinvestment.
That's right.
And then it normalized, and then the wreckage afterwards was pretty tough.
I think Oracle, speaking about valuations, is a great company. My company was one of their first partners back in the early 90s. I actually met Larry Ellison back in those days when they had just gone public, I think, 89 or something like that, as I recall. But their PE's what, 60 to 70. I mean, that's when it gets kind of scary.
This is the fundamental problem right now, is that we've dislocated from classic discounted cash flow valuations, right? I saw, I look at some of these PE ratios and I go, these are big companies to pay this kind of PE. It would be different if it was some young up-and-coming company, right, that was really going to grow into it. But the PE ratios on something like an Oracle are quite expensive. And even if you look at the Microsofts of the world, look, they're great companies. They're just not cheap.
Yeah.
And if they were to normalize at all, you would run into a big issue for the market, because the market is literally 40% in 10 stocks right now.
Yeah.
And so I think that's what investors need to be aware of, is what's driving it. I think you need to make sure, again, that you're diversifying, because there are some good deals under the hood. But I saw an interview the other day with Tom Lee, who's on CNBC all the time. There was a podcast that he was on, and he was talking about how, like, Walmart and Costco have actually got like 50 plus times PE ratios as well. And he was talking about how they've used technology to really streamline their operations, and that's justifying this new valuation. I'm like, well, but the profits aren't there, and the profit growth rate's not there to really justify that kind of valuation. And he was talking about how banks could use AI. Like JP Morgan could go from 30,000 employees to 20,000 employees using AI, and that would give them a better multiple. I'm like, well, the multiple is a function of like your growth rate, your beta, right? How much you fluctuate with the market and what's happening in interest rates. Just to randomly assign PE ratios based on these esoteric factors doesn't make sense.
Yeah, that's
not
a
the
minimal impact on the E part of the PE, right?
Ultimately, yes, we will go through phases where people will just start assigning PE ratios. Back in 2021, it was total addressable market, right? Remember ARK?
TAM.
ARK Innovation ETF, right? It was all, well, the total addressable market is this, and then all those companies got trashed by 80%.
That's right.
Right? So I think that, ultimately the fundamentals matter, and hence why I think you need to be well diversified.
So talk about, I know what you guys do, and especially helping those who are planning to go into retirement at some point, want to make sure that they can live a comfortable life. How do you help them with that?
Yeah, well, I mean, I think the first thing that you have to do is you got to kind of sit down and you've got to inventory what you have. You've got to look at your current cash flows, your future cash flows, and you got to figure out, where the money is going to come from, right? How are you going to generate that sustainable income in retirement? And you also have to you got to look at the risk in your portfolio. If you're going into retirement and you're sitting there just banking on markets continuing at the rate they've been going up, you might be sadly disappointed. I mean, I use the example of 2000. If you were 100% in the S&P 500, you took 4% a year out, you bumped it up by a couple percent a year to keep up with inflation, well, you ended up running out of money in your 80s, right?
Yeah.
And so you really have to understand what you own, how you're diversified, but more importantly, how are you going to generate paychecks in retirement, and how are you going to manage the unknowns, right? The volatility that could come down the road.
Are you feeling like that because people are living longer and they're a little concerned about their assets, they may stay in the workforce a little longer?
Yes, but what we're seeing is that a lot of people end up getting forced out.
Okay.
Right? Some people would like to, but then some people end up getting forced out of the labor force. I always tell people who are pre-retirement, sometimes people don't know exactly when they want to retire. My point to them is, all right, well, let's figure out the point at which that you're working because you want to, not because you have to. Right? And that's the key there. And now, obviously, look, full Social Security is now 67. It's not 65 anymore. All right? Now, Medicare is still 65. So 65 is still a big trigger for most people to look at. But the reality is, yes, we do live longer.
Yeah.
So a lot of people are having to work.
Well, because you may outlive your assets. That's the fear, is it not? Do you run into that some?
The number one fear financially, right, that people have is that their money won't last long enough.
Yeah.
And you have to, but the only way you're going to know that is to run a financial plan and test it and see what it looks like.
And that's what you guys do?
Yeah.
Yeah. Well, you've done it for me, and it's worked quite well. I can certainly say that with a high degree of confidence and experience for now, 5-6 years,
Yep.
I think. So, yep. Always good talking to you, Jeremy. Appreciate you coming in.
Always a pleasure.